Good afternoon from Washington, D.C. Today is Thursday, January 11th, 2018, and Venable welcomes you to our webinar, Consumer Financial Services Outlook 2018. My name is Alexandra McGarris, counsel at Venable and a member of the Consumer Financial Services practice. In the wake of major changes at the Consumer Financial Protection Bureau and a year into the Trump administration, our panel today will preview what's on the horizon for consumer financial services law and policy, and will outline what you and your company needs to know about what to be on lookout for the year ahead. Today I am joined by my amazing colleagues Andy Arculin, Allison Baker, Andrew Biggert, Jonathan Pompan, Jerry Sachs, and Kara Ward. But first, some housekeeping. Our webinar today will be recorded and downloadable, and the slides will be available later this week. Please follow the on-screen prompts for submitting questions to us, and we will do our very best to answer them at the end of the session. Of course, contacting us and asking us a question does not create an attorney-client relationship, and the opinions expressed today are those of the individual attorneys. And please do not send us confidential information. CLE will be offered for today's webinar, so stay tuned until the very end for the code, which will be presented in the chat feature. If you advertise or offer consumer financial products or services such as loans or other forms of consumer credit, if you take payments, furnish data to the consumer reporting agencies, or collect debt, then you're likely asking, what's next on the legal horizon? Of course, there's no shortage of topics that you and we're following. In the years since we last provided an outlook in January of 2017, the significance of the political landscape has evolved and taken on more importance. Today we will cover the following topics. First, we'll look at the CFPB's developments and its new management and the political landscape as a whole. That will be covered by me and Kara Ward. We then will turn to Andy Arculin, who will talk about the CFPB's rulemaking agenda. Then we will cover consumer financial services enforcement, presented by Allison and Jerry. We will then turn to advertising of financial products, covered by Jonathan Pompan. Andy and Jerry will then discuss consumer lending. Andrew Biggert will then discuss fintech issues. And then finally, Jonathan will cover debt collection developments, and then we'll be happy to take your questions. So, for those of us here who have been following the CFPB's every move since 2010, the last 6 weeks have been somewhat surreal with all of the national media attention on the Bureau. I wish I could say that the national conversation has been on the appropriate role of government in regulating consumer financial markets, but instead what we have is like an old-fashioned spaghetti western showdown. But first, let me take you back to a long time ago in a galaxy far, far away. The Bureau's very first director, Richard Cordray, had been serving a 5-year term, which was scheduled to end in July of 2018. Under the CFPB's enabling statute, the president can only fire the director for cause, which, of course, is the subject of a constitutional challenge brought by a company called PHH and currently under review by the D.C. Circuit Court. Of course, the Bureau under Cordray's tenure had been very active in both rulemaking, enforcement. Many critiqued the agency during this time as potentially overreaching. And since Trump's election, speculation had been swirling around D.C. about whether the president would nevertheless try to fire Cordray, causing a clash. And when it became clear that he would not do that, the question, of course, then became whether Cordray would step down early in order to throw his hat in the ring and run in the Ohio gubernatorial primary. So about 1 year after election, the day after this past Thanksgiving, of course, Director Cordray did resign. And hours earlier, he appointed his chief of staff, Leandra English, as deputy director of the CFPB, a position that had been unfilled for years. That same day, the president appointed Mick Mulvaney, the head of the Office Management Budget, OMB, triggering a face-off that has since played out both in media and in the court. In the days that followed, Ms. English filed an emergency TRO with the District Court of Columbia. Ultimately, that was denied, and then an injunction was filed. And just yesterday, breaking news, Judge Kelly denied the request sought by Ms. English and concluded that the president properly installed the acting director, Mick Mulvaney, as the acting director. So now, Kara, talk to us a little bit about not just how the CFPB is going to change in the wake of these developments, but overall the landscape in the consumer financial services and the regulators that oversee this.
Thanks, Alex. You might be asking yourself, so what's the net impact on my business, and what can I be doing, or how should I be viewing these changes? And before you is a slide here that has been pretty well covered by some of the trade press that we've been looking at, but look at the highlighted area of how the mission statement that appears at the bottom of all of the press releases and other official documents coming out of the CFPB. I highlighted the new text. So it says, regularly identifying, addressing outdated, unnecessary, or unduly burdensome regulations. That phrase is very commonly seen in Paperwork Reduction Act or small business considerations when a rulemaking is published. It's also the sort of vernacular of folks in the policy realm who are testifying before Congress or looking to launch an Office of the Inspector General sort of study or investigation. So here's what, assuming that Director Mulvaney stays in place, and as we do expect that he probably will remain in that seat until about June or July, when the new director will be named and seated. But what can we expect? And I think it's because the new leadership that's coming in is largely coming from a political operative background. So their toolbox is a little bit different than the places where Director Cordray staffed. And keeping in mind that the CFPB is the sort of place that's very statist, meaning that the director and the director's office wields a great deal of power, and most decisions are going to require sign-off at those most senior levels. There's not much going on. Supervision is a separate issue, but not much going on that doesn't pass underneath their desks, or over their desks, I should say. So the toolboxes of the new leadership is looking less like the sort of litigation-heavy argument precedent and evidentiary backgrounds that would normally carry the day in a regular policy discussion at CFPB. What's happening here is there's a bit more of the toolbox is looking like a consensus being built around folks who would generally agree with an underlying regulatory principle, and that would be outdated, unnecessary, or unduly burdensome. Starting with that thesis in mind, the conclusion that you would like to have the CFPB draw from anything you're putting before them, you'd be looking more for outside resources that generally confirm the viewpoint of the folks who are newly installed in the leadership offices to validate that. So you'll see on my chart where we used to see sort of arguments and cases or amici briefs coming out of CRL and NCLC and places like that. You're now going to be seeing more think tank papers coming out of places like Mercatus is an obvious place, and but the other is what's the congressional record on this issue, and particularly as House Financial Services taken up the issue. Mick Mulvaney came from House Financial Services and is one of the founding members of the Freedom Caucus. So we're starting to see Chairman Henserling's former staff come in and do a lot of the spade work for the director's office. And if House Financial Services has been on the record on the issue, you can be sure that this is something that the leadership is familiar with or will have seen before. And that's one of the tools to keep in your toolbox is there a hearing now on the issue? Has there been one in the past, and have we participated, or has the position we want highlighted been covered? Similarly, oversight, I think, is going to pivot from using the consumer complaint database as a real sort of fact-finding mission into one where it's shifting to the Inspector General and the issues of concern that are happening or originated or bubbling up from Main Street, and Main Street being Main Street banks and Main Street businesses. So you're going to look at Congress, what's on the top of their mind. And we've said this a couple of times, fraud will be fraud. And no one, that's a bipartisan issue. No one has an interest in maintaining fraud. But I think if you look at the history of the Inspector General reports and where their agenda for 2018, which has not really been published yet, but when their agenda for 2018 starts to coalesce, that's how you can start to predict or start to mold your strategy for handling CFPB policy concerns take shape. With that, I'll take it back to Alex.
Oh, Kara, if you can just spend a little bit more time on that issue of maybe a de-emphasis on the consumer complaints. Are you saying that won't be the source of the Bureau's kind of priority setting?
Sure.
Expectation?
Well, if the consumer complaint database lasts another 6 months, and I'm not entirely sure that it will, if it's retained, I do not think that it will be a place that creates the priorities in the way that it has in the past 2 to 3 years for new investigations or new rulemaking concerns.
So Andy, pivoting to rulemaking, given what's been going on these last 6 weeks, the potential of a new director being appointed and seated in the next maybe 6 months, what is the CFPB's agenda today and in the coming months?
Sure. So it's interesting. If you go forward one slide, there's the fall 2017 rulemaking agenda, which is the last rulemaking agenda that we have. I still think this was done before Rich Cordray resigned, so this was done under a prior administration, so to speak. But I think it's a good indicator of where the CFPB is headed. It's certainly a good indicator of where the CFPB staff intended to head under new management. For the last year, everyone had essentially been waiting for Rich Cordray to announce that he was going to resign and go run for governor of Ohio. So this rulemaking agenda was done, later in the year. It was done with that change in mind. You can just at a snapshot look at it, and you can tell that this is far more business friendly than we've seen in the past. There aren't the controversial discretionary rulemakings that the CFPB is really looking to blaze a trail with, like they did with the arbitration rule or the payday lending rule. What you have instead are, there's a lot of look-back oriented rules, meaning the CFPB will be re-examining rules that it's done in the past. To the point Kara made before, the emphasis might shift from consumer protection to whether these regulations are unduly burdensome or unnecessary. Do they restrict things like access to credit? I expect that to be a big emphasis moving forward. You still see there's some rules that are in its infancy. The overdraft and debt collection rule in particular, which Alex and Jonathan will talk about later. The fate's more uncertain, but what you'll see a lot of is revisiting of the mortgage rules and fixes to existing rules that are done. They're law, but they have not yet taken effect, or they've taken effect and they've created some compliance challenges. So the 5-year look back, the refocus on the mortgage rules, this will be a large part of what the Bureau is doing over the course of the next year. And again, that would have been the case if Rich Cordray had been able to stay on for another year, or even if Elizabeth Warren were running the agency. This is a statutory look back. This was part of the Dodd-Frank Act. The CFPB has an obligation to go back and examine and study and issue findings about all of its rules that it did under Title 14 of the Dodd-Frank Act. If you recall, those are these various mortgage rules: ability to repay, loan originator compensation, mortgage servicing, integrated disclosures, and so on. What the CFPB, has been planning, and again, they issued requests for comment last year. They got some limited comments about their look back plans. They will be assessing the rules, but, and this is critical, they'll be doing so under new management and under new thinking. What does that mean for the industry? Well, in the past, if you've really harped on issues like access to credit, if you've raised concerns with the CFPB that the rules are too burdensome, they're choking off access to credit-worthy consumers because they're too hard to comply, or in the case of ability to repay, there's no way to make certain loans as, quote, qualified mortgages. That discussion will be different this time around. There's lots of issues that folks in the past have tried to raise with Director Cordray and gotten reception, gotten a meeting. maybe even gotten a good productive meeting but no results. There's certainly going to be, I think there already is, but moving forward will be a new sheriff in town. As Kara mentioned, the CFPB director has enormous influence. So I would expect you have someone more business friendly driving that agenda down to the staff, and then the staff implement. I would expect there to be a lot of discussion about small bank exemptions for small banks, credit unions, small lenders, small servicers, expansions of what already exists, expansions of safe harbors, and an issue that's been a pain point for everyone in the mortgage lending industry, especially regulatory cures. So if there's a disclosure violation that occurs, you can cure it before you sell your loan, and you don't have to worry about there being a deficiency on your loan and having to discount it or be unable to sell it. Another issue that will be really interesting to watch under the qualified mortgage rules, the way that most of the market has been making loans as qualified mortgages since those rules came about has been under the quote GSE patch. That basically means your loan is eligible for purchase by Fannie Mae or Freddie Mac. If you can pass an underwriting test, you don't even have to sell it to them. You can do that as a qualified mortgage. That expires. It expires soon in 2021, and from what I've heard, even before Cordray resigned from the staff, they are not looking to extend it. Again, there will be a new director, there'll be a new discussion about it, but the current plan is not to extend the GSE patch. That's going to be a very big deal for everyone in the industry because the CFPB will be looking to craft a permanent solution. TRID and HMDA, of course, there's just regular maintenance of those rules, fixes. Again, if you've had issues that were pain points in the past that you'd like to revisit, now is the time. On the non-mortgage side, very quickly, the main one I want to highlight here is the fate of the payday small dollar rule. That rule was finalized back in November, actually in October, but it was published in the Federal Register in November. There's still an opportunity for Congress to kill it under the CRA, the Congressional Review Act. They have passed a House resolution, but to date nothing's happened in the Senate. It looks like we have the legislative calendar is somewhat of a moving target, but as it stands today, probably the early spring is when that clock expires. Assuming that rule stands, there's an implementation period. It's roughly 2 years from publication, a little bit less, but those in the industry will need to implement it and comply with it. Part of what we've seen already is a migration away from traditional payday loans into more traditional installment loans. One of the things CFPB did in the rulemaking was take those longer-term loans out. Originally, they would have been subject to coverage if they had an all-in APR that exceeded 36%. That's no longer the case. That could help their cause with the CRA. That could help their cause with, a willingness of the industry to go back in and ask the agency under new leadership to roll it back or kill it. But I would expect some efforts to reengage the CFPB under new leadership on this rule as well, assuming that Congress doesn't make it a non-issue. Debt collection, prepaids. Debt collection I'll save for Alex and Jonathan to talk about later because I know they have some things to say, but there's a question of whether that rulemaking will happen. And again, it's not as simple as it may sound. The industry isn't wholly opposed to a debt collection set of rules, but there are some complexities there that need to be dealt with. The CFPB will continue to tweak prepaid card rules as it already is doing.
And this is Jerry, just to chime in with the prepaid card rule. From what we're hearing, we anticipate there will be at a minimum a significant delay in the implementation of that rule. Industry is pushing for, at a minimum, a significant delay up to a full-out repeal of that rule. So again, at a minimum, we're expecting a significant delay in the implementation of that.
Okay. And the other two are just, these are rules that I pointed out that have not happened yet. They haven't been proposed. They were ideas that the Bureau has on the agenda. Unclear whether they will happen. That's overdraft and small business data collection. And so I'll turn it over now. We're going to shift gears a little bit and go to consumer financial services enforcement. I'm going to turn it over to Jerry and Allison.
So looking first at the CFPB, which used to be the elephant in the room, for lack of a better way to put it, it is still active in litigation. And while its focus is now more on regulatory relief and more access to credit, it still has active litigation ongoing. We have seen some filings occur don't anticipate that they are going to withdraw every single complaint or withdraw from every single litigation ongoing. There is a possibility that some of that will happen just by looking around the current administration and what has occurred at, for example, the Department of Justice or other agencies. It is not unheard of, and likely will not be unheard of, for the CFPB to withdraw from litigation depending on the stage of that litigation. They are still active with investigations and issuing civil investigative demands. It's unclear as to whether that is because those can be issued at a lower level and not necessarily with the sign-off of the current director. I would anticipate the priorities on how they issue and to whom they issue civil investigative demands to change in the months going forward. Clearly, with a new director, that would change.
Allison, I understand that under the new acting director, all enforcement matters are under review. That's been the headline. What does that mean, and what can entities expect in terms of how long that's going to take?
Terrific question, Alex. So here's what I'm seeing. I actually have a number of open investigations that I'm handling before the Bureau. And, you know, there's always been, and it's kind of a joke amongst those who do work before the enforcement office, to kind of hurry up and wait. So you rush really around, you get them what they need, and then you don't hear from them for months or weeks. And what I'm seeing here is a similar pattern, except what's clear to me is that there's a certain amount of uncertainty. I've actually had folks in the enforcement office kind of tell me that in so many words. You know, they're not certain about the status of how the enforcement office is going to proceed generally or particularly as to certain matters. That doesn't mean that they're going away. It doesn't mean that there are going to no longer be any CIDs, as Jerry just said, or investigations, or even litigation in district court pursued. But what we are seeing is definitely a slowdown and some kind of implied uncertainty. And I say implied because obviously no one's coming out and saying, hey, we don't know. But there's definitely been that response. And I have a number of matters where hair was on fire 6 weeks ago, and now everyone is kind of chill. So, you know, it's hard to know exactly what it means, to answer your question, Alex. And candidly, I think it's a work in progress because I think the leadership of the Bureau is taking form as we speak. Obviously, Director Mulvaney, you know, has to have some folks in place who are his people, and I understand those people are being put in place this week. Some of them were put in place last week. So some of this is going to take a little while. One thing I note about enforcement is it's probably the most, in some ways, the most public-facing aspect of what the Bureau does. Not necessarily the most far-reaching in some ways it isn't, and in some ways it is, but it's definitely the most public. And so if you see some kind of stop or potential stopping of enforcement actions, that will definitely ultimately shape the public's perception of the Bureau, whether or not at the end of the day it actually materially impacts everything the agency does. I'm not sure it will. I kind of continue to think that supervision is going to remain active. I think to some extent, and Andy just talked about this, rulemaking will, but you may see a slowdown in enforcement. And Jerry, I don't know what your thoughts are about other agencies kind of stepping into the fray.
So to echo what you just said, Allison, I think you will see supervision remain active and continue its operations. And a large product of that is industry, while it is a regulatory burden on industry, it is generally resolved in a confidential manner. So there is low reputational risk. There may be some remediation risk depending on the findings, but it's a low reputational risk. And so expect to see supervision continue. With regards to enforcement, there may be a lull in enforcement activity, but that doesn't mean that the Dodd-Frank Act will go dormant. We've already seen a number of state attorney generals say that they are going to pick up the slack everywhere from California to New York. And there is also, of course, other federal regulators. The Federal Trade Commission is still issuing civil investigative demands. The chairwoman has made it clear, though, that there is a burden on businesses, and that should be considered. They are still actively litigating, and they are looking at new issues. A couple of the areas that the FTC looks at overlap with the CFPB, and some don't. The FTC will continue to be active in anything relating to data security and privacy, payment processing, lead generation, multi-level marketing, financial coaching programs. And more recently, it appears that the Fair Credit Reporting Act responsibility, there may be a slight shift in pushing that back to the Federal Trade Commission. We've seen two senators push a proposal to give the FTC data security over credit reporting agencies. And of course, some of that stems from the fact that the FTC has more Gramm-Leach-Bliley Act authority over that type of issue than the CFPB. But nonetheless, it's significant to note that the FTC is still around, has been around for 100+ years, and is still active. Another area in the federal level that will be active, at least to some degree, are the prudential banking regulators. There may be a view that they've scaled back, but there may be a view that they haven't. By way of example, the Federal Reserve Board in the past year has hired roughly 15 to 20 enforcement attorneys. So you can expect increased activity from the board, whether that's with Bank Secrecy Act and anti-money laundering, or with UDAP, which they enforce the Federal Trade Commission's UDAP authority.
And some of those folks came from the CFPB's enforcement office. They started it at the Bureau, and then they went to the Fed's kind of beefed up efforts. So I think that you may see the Federal Reserve pick up some of that slack as well.
And Allison, how do you think the state attorney general's offices and other regulators, how do you think they will leverage the Dodd-Frank authority or UDAP? So
a few thoughts on that. What we're seeing in our practice is a lot of state attorneys general activity in law enforcement in the consumer finance space. There's a handful of state AGs who are kind of leading the charge on this. Healy in Massachusetts, Schneiderman in New York, Racine in D.C., probably the new AG in Virginia. You're going to see some activity, I suspect, from the relatively new AG in North Carolina. Washington State is very active. Lori Swanson in Minnesota is very active. Madigan, who is not running for re-election but has a spate of people from the Democratic Party in Illinois running. I'm sure that office will continue to be active. And what we're seeing is a few things. One, the Dodd-Frank Act enables state AGs to enforce its provisions. Number two, there's a bill in Congress that nobody's talking a lot about, which is fascinating to me, that it would essentially enable the state AGs to pursue civil investigative demands against nationally chartered banks, essentially undoing some of the earlier preemption rulings from the OCC that were not quite codified into Dodd-Frank because of politics at the time Dodd-Frank was passed. 1042 of the Dodd-Frank Act talks about that. And number three, we just see a lot of resurgence activity in general among all kinds of state AGs, not just the big ones I named, but also some of the smaller states are really getting active as well. And I can't say enough that that's where the action's going to be in the next couple of years.
Jonathan, let's move on to advertising. Those that are involved in advertising consumer financial products and services, what do they need to be concerned about? What's on the horizon?
Well, advertising and marketing, whether it's lead generation by third parties that ultimately generate leads that are purchased by consumer financial services companies, or advertising and marketing directly conducted by consumer financial services companies, has been certainly at the forefront of the attention of regulators, and it has, in many respects, faced increased scrutiny over the last several years on both the federal and state level. And that's relatively easy to pinpoint the reasons why. Not only is there increased enforcement authority, as was just discussed by Jerry and Allison, and especially at the state level where state UDAP authority was augmented by the Dodd-Frank Act, as well as also the fact that in many cases, government regulators, whether it be on the supervision side or directly on the investigation side, find it to be relatively easy to bring claims for UDAP related to education and marketing. And oftentimes that's been in the small dollar loan space, the education space, as I just mentioned, but also in just the general loan space. And so whether it's a UDAP claim or if it's been a technical claim related to, for instance, the Truth in Lending Act or other areas, the viability of some forms of advertising and marketing have been challenged, and we expect it to continue to be challenged going forward. Another area where it becomes relevant is on state compliance with regulations specific to particular industries. Already in the past, recent years, mortgage advertising in particular, but also small dollar loan advertising, and other forms of loan products have come under scrutiny related to state licensing laws. Oftentimes there's a broker statute or something that could apply to a broker of loans, and whether or not they're soliciting or taking an application or otherwise involved in the actual data transfer, there's a potential for state regulators, in addition to state attorneys general, to play a role, and increasingly they are, particularly in the spaces that I mentioned. And then native advertising is something I think everybody should be paying attention to in the consumer financial services space, and social media influence. It's been a hot topic for the FTC, and I think it's generally going to creep into other areas too of scrutiny. For those who haven't been following the trends closely, native advertising is a form of digital advertising where the advertisements include in-stream interspersed with regular editorial content, or on social media platforms, it can take the form of like a promoted post. But exactly how transparent that is and the type of disclosures that are appropriate and should be made is an area where people have come under scrutiny and face some liability.
So moving on from the advertising of lending products, Andy, Jerry, let's talk about lending directly and what folks need to be mindful of in 2018.
Sure. So happy to do that. And I think Jonathan actually makes a nice intro with marketing and advertising. A lot of the activity we have seen, as Jonathan mentioned, has been about selling leads, whether it's for mortgages or even for non-mortgages, whether you need to be licensed, the various laws that relate to advertising. I'm going to talk a little bit about RESPA, which comes up anytime you're doing mortgages or any settlement services that relate to real estate. But first we're going to start with non-mortgage. This has been a hot area. We're also going to tee up some issues for Andrew to talk about in a bit related to fintech. He's going to get more into the weeds there. But on the non-mortgage lending side, there continues to be a lot of activity. Much of it centers around what happens with the CFPB installment loan rule. As I mentioned earlier, the payday lending rule, the ability to repay requirements and underwriting requirements that the CFPB imposed there, do not, under the rule as adopted, apply to most installment loans. We've already seen a great migration of that market into traditional installment lending. There are lots of customers who need to be served. There's demand for credit. The market is creative and will find a way to serve it. The trick is getting set up under state regimes, getting set up under state usury laws, and getting set up under state consumer protection laws, and finding a way to make a profit. And Jerry, one issue we have on the list is the OCC FinTech Charter. Do you want to talk about that for a minute?
Sure. So, the FinTech Charter was something proposed under the previous comptroller of the currency, and it is something that is likely to be continued under the current comptroller of the currency. It's one of those things that will survive administration, surprisingly. From my understanding, there are a lot of informal conversations going on with the OCC about fintech charters. There has not been a formal one yet, but that's the start of the process, as it is with obtaining a bank charter, talking to the OCC, determining what they want, and then submitting exactly what they're expecting to get. And so we expect to see a lot more activity in that regard. And as you mentioned, Andy, part of it is legal compliance and having some certainty. The CFPB issued its first no-action letter last year to an online lending company that had some concerns about fair lending and disparate impact. And the CFPB provided them with some certainty. This is an area where we could see some action during a new CFPB director or regime, because it can provide some certainty to industry and open up credit to consumers and allow business to flourish with a somewhat safe harbor. And that ties in to the disparate impact auto fair lending initiative that was undertaken with the CFPB. And while disparate impact is still a law that must be complied with, enforcement may not be as strenuous or as strong as it was under the CFPB, but nonetheless, those laws are still in place. So whether that's ensuring that your business or entity has minimal fair lending risk, it's something that you want to do because you could see private rights of actions or states take on some of that responsibility.
Yeah, to piggyback off what Jerry just said and add a little additional flavor regarding fair lending, there's two unique sets of fair lending issues that we've been seeing that go outside of mortgage. One relates to the fintech industry. A lot of fintech companies have alternative ways of underwriting loans. They have different data points that they examine and that they make credit decisions based on. Some of these can be done by social media scraping or reports from companies like Yodlee and so on. That's different than traditional lending models, and it makes regulators uneasy because they don't really understand it. They don't understand if it has a disparate impact on a protected class. And much of the industry doesn't either. These are relatively new concepts. They haven't been tested. And you do have a lot of startup companies who are not necessarily going out and doing fair lending audits every year and analyzing data. And when their idea starts, quite frankly, they may not have any data to analyze. So that's an area to watch, a development to really keep your eye on as we move forward. And again, we're talking about various agencies that can enforce fair lending laws, whether it's Department of Justice, the CFPB, state attorneys general, or the banking regulators themselves, depending on whether there's a bank partnership or whether it's a non-bank and so on. That will be a really interesting area to watch. The other one is auto lending. Jerry touched on this too, but as everyone knows, the subvented rate structure does invite the opportunity for fair lending issues. And you basically have companies buying loans. They have to do quality control. Some of them are directly regulated and examined by the CFPB. So the CFPB, Supervision office can come in and do examinations. Regardless of the enforcement office's priorities, if you're undergoing an examination, you should have a defensible basis for your fair lending operation. You should have a fair lending plan and so on. And the same goes if you're state regulated. So those are areas where I expect to continue to see a lot of interest, a lot of activity going well beyond the CFPB.
And briefly, because we have it on our slide, the true lender issues we will cover later, but we just wanted to note that in addition to state true lender issues in complying with state law and whether you can export interest rates, the CFPB threw sort of a wrench into this with one of its small dollar lending cases. And again, things we will touch on in a little bit.
Okay. Shifting to mortgage, this is an area, I've already talked quite a bit about it, so I'll make it relatively quick. The big development is the HMDA rules have now taken effect. There is, the various data points that you have to start collecting under HMDA. The new reporting mechanisms and so on are now effective. Obviously, we're in the first year of collection. Reports haven't begun yet. And CFPB has, consistent with their prior practices, come out and said that they're looking for good faith efforts at compliance. They're not looking to build cases or fine everyone who gets something wrong with their first year of HMDA collections. That's been passed on to the other bank regulators as it has in the past too, and I expect all of the other bank regulators to take the same approach. One thing I'd point out with regard to HMDA, two things actually. One is the fair lending risk that's associated with it. Once you start reporting all of this data, there'll be a lot more data to mine. That's relatively well known, but keep your eye on it. The other is if you are a bank and you're supervised by one of the prudential regulators and you have to comply with the Community Reinvestment Act, the fact that the regulator takes a kid gloves or a soft approach to compliance on HMDA doesn't mean that you're not going to have to produce a good, valid HMDA LAR for your CRA exam. Regardless of whether the enforcement office at the specific agency has a directive not to fine you for ticky-tack violations, I still think you could run into a lot of problems if your HMDA LAR is incorrect or it has errors all over it, because it will make your CRA examiners unable to do their jobs. So if that's something that you have to worry about, I would make sure you're extra on top of HMDA. Jonathan talked a bit about marketing. RESPA continues to be a statute that's everywhere. It's confusing. The CFPB really blazed some trails with their enforcement activities in the past and scared a lot of the industry out of doing anything that touches on RESPA. What I've started to see is a thawing in the relationship with the CFPB over RESPA, less terror that the CFPB is going to make any molehill into a mountain and bring a RESPA action. And more willingness to engage in marketing partnerships or strategic relationships, lead sharing arrangements, and so on, but still in a RESPA compliant manner. And what I mean by a RESPA compliant manner, consistent with existing best practices, consistent with all the precedent that's out there. because it's still a very tricky area. It still can be enforced by states, by private litigants, and so on, and the CFPB if it's egregious. But that's an area of development that we're going to continue to watch. On the mortgage area, I think Jonathan talked about state licensing and lead generation, so I won't spend any more time on that. We can go on to servicing. Two things I'd note here. One, there's an effective date in April for some of the rule changes under the last round of servicing amendments. Those relate to successors and interest, identifying successors and interest, giving them rights under the servicing rules, and so on. There are specific rules related to bankruptcy servicing and disclosures that you have to give to comply with the servicing rules for borrowers in bankruptcy that take effect this year, and again, you will have to start complying with basically the same case as the other rules. You'll have a period of good faith compliance, but important that you're on top of that. Another area that I flagged that's really been a hot area of development is limited English proficiency. This comes up all the time. This is a confusing area. It's generated a lot of confusion and questions from the industry to the regulators about how this interplays with fair lending laws. Naturally, there's a connection between ability to speak English and natural origin. Natural origin is a protected class under both the Fair Housing Act and ECOA. So how do you provide how do you serve LEP customers, and how do you do so in a compliant manner? We've gotten formal guidance from both HUD and the CFPB about how this works under the Fair Housing Act and ECOA, best practices that can be followed. The tricky part, in my view, what this guidance really says is once you go down the road of providing LEP services, negotiating loans in a foreign language, then you have to be able to service that loan in foreign language. You have to basically be able to do everything in a foreign language. So the first step is that strategic decision. Do you provide LEP services at all? And if you decide not to, are you complying with fair lending laws?
And the CFPB has issued some guidance, and their supervisory guidance has really said, look, you can offer translation or interpretation, and you can advertise in a foreign language, and you may not have to fulfill everything in that foreign language, but your advertising on the front end better be extremely clear of what services you're offering in that foreign language or not, to the limited English proficiency population. So it does raise some risks. And just to mention, on the tail end of that, while we have received some guidance from the federal regulators, there are a handful of states that have conflicting versions that say if you're issuing, for example, advertising in any foreign language, you must follow entirely through in that foreign language. So while there is some guidance from the federal regulators, you have to always check that with any state level regulations or guidance.
So Andrew, let's talk about fintech. You got a few previews on this topic, so let's jump in.
Great, thanks. I'm happy to spend a few slides here discussing recent developments impacting fintech, as well as looking forward to some of the issues that may impact fintech in 2018. Of course, as you can see on the slide in front of you, it's an extremely broad term that covers some very different types of companies. We're going to spend most of our time today talking a little bit more on some of those industries where you see a more direct intersection between fintech and consumer finance. So what are some of the developments that have been happening with fintech and are likely to continue through 2018 and maybe even beyond? And we're going to talk about these on some of the next slides. First, I think that there has been federal scrutiny of fintech. Sometimes you maybe hear that it's an industry that's not regulated, and I don't think that is necessarily the case. It's certainly, as you've heard from a lot of the other speakers today, a lot of the issues that they've been talking about impact fintech, and that's going to continue. Also, figuring out where are you being regulated from, at the federal level, at the state level, kind of who has primary jurisdiction over some of these, where do they share and overlap, something that continues to get played out. A lot of state regulatory challenges that are out there, particularly on the lending side, which is something that Jerry and Andy have been talking about today. And then finally, we'll touch just very briefly on cryptocurrencies at the end, as that's certainly an area that's gotten a lot of attention, but maybe is still kind of coming into its own, and it's unclear exactly when that industry will fully break out. So looking at continued federal scrutiny and how this may continue to play forward this year. Some of the topics that are likely to get attention are data breach and cybersecurity, There's been a lot of attention in the media and press about that. Obviously, Congress is looking into that. And the question can become, when is it time for national standards? Obviously, there are state breach notification laws at the state level, and that creates a lot of issues. And there's a lot of discussion, and particularly on the trade association side, as to whether or not a national standard would be prudent at this time. Data sharing, third-party access to consumer financial data, something that Andy talked about earlier. The CFPB has come out with principles for consumer authorized data sharing, so when they can share data and a fintech provider can use that information for different purposes. The CFPB came out, I think, with 9 different principles. Just to give you an example of what some of these are, access. Consumers should be able to obtain information about how their information is being used. Consumers need to be providing informed consent to allow how their information is used and to have control over that. And then obviously, while you may be giving authorization to use data, that by itself is not a payment authorization, and there always needs to be separate authorizations when it comes to making payments. Alternative data and lending, something also Andy and Jerry touched on, and is a big issue in the fintech world where rather than looking at traditional credit information sources, they may be looking to alternative information to help with their credit decisions. And the question from regulators there is, does it create a disparate impact, as Andy suggested is a potential concern? The counterpoint to that is maybe it helps with financial inclusion if you're able to get individuals that have thin credit files access to credit that they may not otherwise get. So that's something that regulators are going to be looking at. On the payments side, Operation Choke Point was announced to be over by the Department of Justice last year, but the CFPB and the FTC still have authority to bring enforcement actions against payments companies, and the FTC in particular has continued to do that. Most recently, about a week or so ago, the FTC had an enforcement action against an individual that helped telemarketers open bogus merchant processing accounts. And then finally, anti-money laundering developments on the horizon. The Financial Enforcement Crimes Network has come out with a beneficial ownership rule that takes effect in May, which requires certain financial institutions like banks, for example, to get beneficial ownership information on their customers. And to the extent that a fintech company is working with the bank, in some cases those obligations may be pushed down depending on the nature of the partnership there. We've already talked a lot today about the OCC limited purpose charter for fintech companies. I think that what's fair to say there is that the new controller of the currency that has come in has said that he continues to support the concept. It's not clear exactly where it's going to be going, but some of the key considerations that the OCC has kind of foreshadowed that they're going to be looking at when it comes to applications are not having an inappropriate commingling of banking and commerce, not allowing for any predatory, unfair, deceptive products or services, maintaining rigorous supervision over any chartered entities, and an emphasis on financial inclusion. Meanwhile, where you've got the OCC kind of doing its fintech charter thing and looking how it can work in this industry, you've got the states, the conference state banking supervisors coming out with a new plan on how they can kind of modernize state regulation of non-banks, which includes fintechs, including a redesign and kind of expansion of the nationwide multi-state licensing system, which is a system used at the state level to get licenses for a lot of non-bank entities. So this is just an effort by the states as well to kind of expand the role that they play in the fintech space.
I'll say, Andrew, what's really interesting too is on the federal policy side, what we're watching is the Treasury is putting together their fintech report, and it's one of the follow-on reports to the Dodd-Frank executive order. That scoping, as I understand, is mostly completed. We'll probably see the report by summertime, if not late spring. And the report's significant insofar as it's going to be the playbook that the federal banking regulators are going to be using for probably the remainders of their terms in office on what to prioritize and how to proceed on fintech issues.
Great. Thanks, Karen. And then just kind of turning to the states, separate from what the developments that are happening with NMLS, you've got individual states that have been issuing rules or new laws that have a direct impact on fintech companies. And I think that it's possible you'll see additional states come out with laws that have kind of broad application, and in some cases kind of overlap or with existing federal requirements. Just two examples of these are New York Department of Financial Services has issued cybersecurity and anti-money laundering regulations that can touch on fintech companies in certain circumstances. Finally, spend a few minutes talking, maybe building out on some of the lending issues that Andy and Jerry talked about. As I think most people probably know, there are two main fintech lending models. There's a bank partnership model, where a non-bank kind of partners with a bank to help with the origination of loans, where they then provide some of the background back office services to help with that, or a non-bank direct lending model where the non-bank actually funds its own loans. And each of these kind of presents its own legal challenges. So with the bank partnership model, there's a number of challenges that can come up. The true lender challenge, where basically a state regulator or a court, in looking to determine which party is actually the true lender of the loan, which for the non-bank that partners there is important because if for exemption purposes, that becomes a pretty important issue. You've got the Madden versus Midland case, which impacted two issues, the valid when made doctrine, and also had a choice of law provision that are important to lenders. The valid when made doctrine states that if a loan is not usurious when made, then it does not become so just when it is assigned to another party. In 2015, the Madden versus Midland, the Second Circuit held that a non-bank assignee of loans that were originated by a national bank was not entitled to federal preemption of state usury laws, which basically rejected the valid when made doctrine. There have been some congressional bills that have been introduced to try to reverse that and codify it, but those are still obviously pending. And then also, some of the other challenges that bank partners can face on the non-bank side is, licensing issues that may go along with that, whether for brokering or making referrals, servicing loans, debt collection as well. And finally, anytime you partner with a bank, you're going to be subject to bank oversight and supervision as a result. On the direct lending side, the main challenges are, finding funding in order to be able to fund the loans, getting state lending licenses, and then the associated burdens of managing those licenses and administrative and regulatory compliance. Finally, we just have a slide up here on cryptocurrencies, which are certainly getting a lot of attention, not just because of the incredible returns on them, in case you've had a chance to invest, but actually applications are starting to come into play when it comes to financial services, which is very interesting. Some of the regulatory developments, there have been a lot of reports that have been issued, and certainly Congress is starting to take a closer look in terms of hearings. Most recently, Senator Warner's and Crapo indicated that they're going to be holding some hearings looking at cryptocurrencies and kind of the regulatory developments there.
And so finally, Jonathan, take us home with an outlook on debt collection.
Thanks, Alex. And whether companies are original creditors or engaged in some form of debt collection on behalf of a third party, or a debt buyer or an investor who seeks to collect on a debt, a receivable, the debt collection legal and regulatory landscape has been one that has been vexing for many, many years and requires a very complex compliance management system. And unfortunately, we don't anticipate too much streamlining in 2018, but there is the possibility for change. That being said, one thing that is of critical importance to nearly everyone in the sector, and eyes have been on, has been the time frame for a modernization of the debt collection regulatory framework that was going to be led by the CFPB, which had rulemaking authority for not just UDAP, which is different than the FTC, but also had rulemaking authority under the Fair Debt Collection Practices Act under Dodd-Frank. And although the CFPB's recently released regulatory agenda predicts a February 2018 timeframe for a proposed debt collection rule, As we've mentioned already, Director Mick Mulvaney has made clear that the rulemaking is on hold as he builds out his team. And we suspect that that hold may last perhaps some time. In response to questions, he's indicated that the hold is on all new rules, and if anything is done, it would be on a case-by-case basis. That said, there's a number of different aspects of the industry in the collections as well as in lending who's been eager to see changes to the regulatory framework and were eagerly going to embrace reasonable regulation. So while the CFPB announced earlier that they were going to have a narrower scope for the debt collection rulemaking that they had already announced, but also have a more accelerated time frame by bifurcating the rulemaking that they had announced several years ago, and there were signals that there was a possibility of having a rule released before Cordray left by the end of 2017, all of that is essentially erased. But the possibility still exists, though. It's just very unclear now and certainly in limbo. But the industry as a result, all players, all the trade organizations as well as different aspects of the lending and credit life cycle, have the opportunity now to continue the discussion both with the CFPB as well as elsewhere on the federal level, Congress and other policymakers, especially also now the Federal Trade Commission, which has always been a player in setting policy related to collections, but also bringing enforcement matters. And the opportunity to take advantage of that and have a role and say in it is one now that is renewed for the industry. Just even last week, the CFPB announced it was putting on hold a data collection effort related to their debt collection rule. And again, that's evidence that there's going to be continued opportunity for engagement and to work closely, if one desires, on what the policy framework is going to be for modernizing the rules, both with respect to just communications and document requirements, but also more complex questions, perhaps ones that are more important related to potential liability under the FDCPA, such as the value of having policies and procedures and the bona fide error moment. In addition, on the collections side, we're seeing still, though, whether it be in litigation or enforcement or in supervision, scrutiny over two different areas, student loan debt collection as well as also general loan debt collection. Those two areas, while somewhat unique, are continuing to get scrutiny from a variety of different places. Student loan debt collection is somewhat unique because it usually involves other aspects of the federal government, sometimes state government, and sometimes government contracts. That area is one where there's yet to been a finish line in sight for the degree of looking backward. And it's a good example of a situation where you could have a deregulatory environment, which is not all that different than we're in now, but say, for instance, 6 years ago or 8 years ago, where those actions can be scrutinized and essentially reevaluated in the future. So in this instance, even though there's not necessarily going to be as much robust public enforcement by the CFPB of the systemic change that we saw in 2014 and 2015, you can certainly see acts and practices today be reevaluated down the road, even in some cases, perhaps even under a new administration, say as CFPB 3.0, if we're in 2.0 now. I think also, too, state licensing and state regulatory agencies and attorneys general are going to have renewed vigor in this area, picking up where there was otherwise gap as a result of the CFPB, perhaps taking a step back, or picking up where the CFPB left off. Either way, we are already seeing increased scrutiny from states over, in some cases, technical matters, but also in many respects over substantive requirements, whether it be related to documentation and litigation practices to the nuts and bolts of collections, such as dialing times and consumer contact. And then lastly, of particular interest in terms of an outlook, I think everybody should consider the concept of bona fide error. Under the FDCPA, there's actually the ability to use as a defense having reasonable policies and procedures to comply with the law. And as a general matter, what we've seen through CFPB enforcement for the last 6 years was, to one extent or another, that policies and procedures and practices and intent was not necessarily enough. They would still take you to the woodshed for what was alleged to be a violation of the law. So I think now, though, as we're looking at the new CFPB and the new regulatory environment, as well as also the consumer litigation environment, policies and procedures created continue to be extremely important to comply with the law, and the concept of self-audit and self-policing will remain critical in order to stave off potential supervisory risk if you're under supervision and a larger participant, or UDAP or FDCPA claims brought by the Federal Trade Commission, states, or even banking agencies that have authority to bring UDAP claims. And of course, under the state rubric, you've got attorneys general who are newly empowered, and then on top of that, of course, the consumer litigation risk. And there's also been one development that I think folks should pay attention to, that if they're not even debt collectors, is what is a debt collector. Last year, there was a major Supreme Court case on defining and interpreting an aspect of the FDCPA in terms of what applies and what doesn't apply, and Henson v. Santander. And that case continues to have repercussions, particularly for those that would potentially not actually face FDCPA liability.
Jonathan, thank you. This is Allison. I just wanted to thank everybody for joining us this afternoon. It's been a really interesting webinar with terrific colleagues. We will be sending out information about our presentation, and if anyone would like a copy of or access to the recording, as well as for an index of articles on related topics that our firm regularly puts out in its Consumer Financial Services publication and digest, please feel free to visit our website, venable.com/CFS/publications. In addition, this presentation will be available later tomorrow, and the recording will be available earlier next week. I really, really want to thank all of our panelists today, Kara Ward, Jerry Sachs, Andrew Bigart, Jonathan Pompan, Andy Arculin, and our moderator, Alex Magaris. And again, for more information, please feel free to visit our website. In addition, I want to give you our CLE code. Oh, no, I'm sorry. We don't have a CLE code. I apologize. I just want to thank you very much for joining us today, and we look forward to having you join us for future webinars as well. Thank you.